Welcome to the Hughes Optioneering Weekly Workshop, where we scientifically engineer trades for greater profit potential. This is the disclaimer slide. You can pause to read it. We are going to move on. Today we're going to look at AMEH, or Apollo Medical Services, Inc. AMEH provides health care services. It offers integrated care, inpatient and physician alignment solutions. Here's the barchart.com technical opinion for AMEH. The bar chart technical opinion rating is a 100% buy, with the strongest short-term outlook on maintaining the current direction. Long-term indicators fully support a continuation of the trend. According to Prime Trade Select rules, a stock is in a bull trend on a monthly basis if the stock price is above the 10-period or 10-month simple moving average. The monthly chart shows that AMEH is well above the moving average line, so the monthly trend in AMEH is up. Now we're going to look at the daily chart. A stock is in a bull trend on a daily basis if the 50-period or 50-day exponential moving average is above the 100-day exponential moving average. The blue line is the 50-day EMA line, and the green line is the 100-day EMA line. The blue line has been above the green line since the chart started, so the daily trend is up. Since the monthly and daily trends are both up, AMEH is on our buy list. Next, we're going to look at a daily chart that displays the Keltner channel. As a rule, we don't want to buy calls if the stock price is above the upper Keltner channel line. Anywhere inside the Keltner channel or even below the Keltner channel is fine. The AMEH stock price is below the upper Keltner channel line, so AMEH is inside the buy zone. Since the trend is up, we want to buy a call. AMEH has 4 option chains to choose from. We're going to use the October 15 option chain. Right now, the October 15 options have 19 days to expiration. Here's the AMEH option chain for October 15. AMEH closed at 95.62 on Friday. That means any calls on the list from 95 to 40 are in the money. Let's take a look at the profit potential for purchasing the AMEH 95 strike call, which is the closest strike to the current price of the stock. The bid-ask spread for the 95 call is 690 to 850. We try to enter at the midpoint, so we use 770 as our buy price. The call option calculator shows the profit potential for this call based on AMEH price changes at option expiration from flat to a 12.5% increase in price. We can see that if the AMEH stock price is flat at 95.62 at option expiration, the 95 call will lose 100% of its value. Ouch! This is an unacceptable risk. That kind of loss can wipe out our trading account in a hurry. We developed what we call the 1% rule to help us avoid this kind of risk. The 1% rule says to limit the time value portion of the option we buy to 1% of the stock price. That means the stock only has to move up 1% for the call option we purchase to break even and start profiting. Now let's take a look at buying the 85 strike call to see if it qualifies for the 1% rule. Here's the call option calculator picture for the 85 call. According to the 1% rule, we want the call to at least break even if the stock price is up 1%. The calculator picture shows that if the AMEH stock price is up 1%, the 85 call will lose 15.2% of its value. We want that to be break even or better, so the 85 call does not meet our requirements. Let's see if the 70 call will work. The bid-ask spread for the 70 call is 24.50 to 27.80. We try to enter at the midpoint, so we'll use 26.15 as the buy price. The 70 call works. If the AMEH stock price is up 1%, the 70 call will make a 1.6% or $43 profit. That's better than break even, so the 70 call is the one we'll buy. The call option calculator also shows that if the AMEH stock price increases by 2.5%, the 70 call will make a 7.1% or $186 profit. If the AMEH stock price increases by 5%, the 70 call will make a 16.3% or $425 profit. If the AMEH stock price increases by 7.5%, the 70 call will make a 25.4% or $664 profit. The 10% and 12.5% numbers are also displayed. You can see that the profits get better and better. And notice that if the AMEH stock price does not make the expected move up and remains flat at expiration, the 70 call would only lose minus 2% or minus $53 compared to the 91.9% or $708 loss for the 95 strike call that we looked at earlier. Now we want to review a debit spread, aka a vertical call spread. For this spread, we want to buy to open the AMEH October 15 expiration 80 strike call and sell to open the AMEH October 15 expiration 90 strike call. We're going to base our entry prices on the midpoint between the bid and ask prices. That means we'll buy the 80 call for $17.55 and sell the 90 call for $10.50. $17.55 minus $10.50 equals $7.05. So the entry price or debit cost for the spread is $705. The call option spread analysis calculator picture shows that the spread will make a 41.8% or $295 profit if the AMEH stock price declines by 5%, remains flat, or increases in price when the options expire. If AMEH is down 7.5% at expiration, the spread will make 19.8% or $140. Creating the debit spread will allow us to collect a $1,050 credit to our brokerage account for the sale of the 90 call. As we said on the previous slide, this reduces the cost of entering the spread to $705. Here is a note regarding earnings reports. The next AMEH earnings report is scheduled for November 4. Let's review the trades one more time. The first trade was a call purchase. It said to buy to open the AMEH October 15 70 strike call for $26.15. We also reviewed a spread.